Welcome to Finance Deep Dive. Today, we're going to talk about something fascinating, how the Federal Reserve can literally move global markets just by talking. No, really, it's this incredibly powerful tool that's become a cornerstone of modern monetary policy. And believe me, it affects everything from your mortgage rate all the way to the stock market. So let's get right into it with a big question. It sounds kind of crazy, right? But in the world of central banking, communication isn't just talk, it's become one of their main tools. Seriously, what the Fed hints it might do down the road can actually shake things up more today than if they actually changed interest rates. And you don't have to take my word for it. Former Fed Chair Ben Bernanke put it perfectly. What he was getting at is that the signals central banks send out about the future can be way more powerful than what they do on any given day. It's all about getting inside our heads and shaping our expectations. All right, so this secret weapon, this powerful communication tool, it has a name. Forward guidance. And its whole purpose is to shape the future by getting into our heads and influencing the big spending and investment decisions all of us make right here, right now. Okay, so the basic idea is actually pretty simple. The Fed tells us, you, me, businesses, what they think they're going to do with interest rates down the line. And just by doing that, they can change what's happening in the economy today, all without even touching the current interest rate. It's really all about making the future feel a little less like a total mystery. But here's where it gets really interesting. Not all forward guidance is the same. Nope, economists have broken it down into two totally different styles. And, being economists, they give them these cool names inspired by Greek mythology to explain the two different ways the Fed can talk to us. First up, we've got Delphic guidance. Just think of the Oracle of Delphi giving a prophecy. This is basically the Fed saying, hey, look, if the economy keeps going the way we think it will, then here's what we'll probably do. The key word there is probably. It's a forecast, not a pinky promise. It's totally conditional. And then you've got the other kind of Odyssean guidance. And yeah, it's named after Odysseus, the guy who tied himself to the mast so he wouldn't get lured in by the sirens. This is the exact opposite of a forecast. This is the Fed making a rock-solid commitment. They're basically tying their own hands, promising to, say, keep rates low for a certain amount of time or until some goal is hit, no matter what. So this table really nails the difference, right? Delphic is like a weather forecast. It's flexible. It gives the Fed room to change its mind if the economic data shifts. But Odyssean? That's a binding promise. It's designed to give the market as much certainty as possible, locking the Fed into a specific path. Okay, so you're probably wondering, how does the Fed actually give us this Delphic forecast-style guidance? Well, one of the biggest ways they do it is through something called the Summary of Economic Projections, or SEP for short. And Wall Street watches this thing like a hawk. So, 4 times a year, the Fed drops these projections, and it's basically a window straight into the minds of each policymaker. We get to see exactly what they're thinking about the economy, about inflation, and crucially, where they see interest rates going over the next couple of years. Now, the star of the show, the part of the SEP that gets all the headlines, is this thing right here. It's called the dot plot. It looks simple, but each of those little dots represents one Fed official's anonymous prediction for where interest rates should be. And man, the market obsesses over this chart, especially that median dot, trying to read the tea leaf. But, and this is a huge but, there's a major catch. The market tends to look at these dots and see a promise. They see Odyssean guidance. But the Fed? They see it as just a forecast, pure Delphic guidance. This massive disconnect is why Fed Chair Powell basically had to warn everyone, calling it a cautionary tale about reading way too much into these little dots. So let's switch gears a bit and talk about the real-world impact. I mean, how does all this talk actually move markets? Well, when the market gets the message, this communication has huge, totally measurable effects on your money. We're talking everything from your retirement account to the interest rate on your next car loan. And the data on this is pretty clear-cut. Research has shown that when the Fed uses clear forward guidance, it can push stock prices up, make it cheaper for companies to borrow money, and lower those long-term interest rates for things like your mortgage. It all comes down to one thing: taking uncertainty out of the equation, which makes everyone feel a lot more confident. And this really gets to the core dilemma, the central tension at the heart of all of this. You see, the market is desperate for certainty. It wants a rock-solid promise. But the Fed? The Fed needs to stay flexible. It needs the wiggle room that comes with just making a prediction, because who knows what the economy will do next. So that's the million-dollar question, isn't it? Should central banks promise the future or just predict it? This is exactly what policymakers are wrestling with in every single meeting. They have to weigh the incredible power of making a commitment against the absolute need to be able to react to an economy that is constantly changing and, let's be honest, totally unpredictable. And yeah, there's no simple answer.
If you like the content, don't forget to subscribe to Finance Deep Dive. It motivates us to keep posting.